G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. So you're thinking about investing in the stock market. Good on you. That's awesome. Welcome to an exciting world. Maybe a bit too exciting, but before you dive in, let's talk about what you need to watch out for as a beginner. Investing can be rewarding, but it's not as simple as picking a few stocks and watching the money roll in. Today, let's walk through some of the key things to keep in mind, especially if you're just starting out. My goal is to help you avoid common pitfalls and set you up for success and hopefully not for you to lose your money. Firstly, investing directly in individual companies is hard, like really, really hard. It's not just about buying a few shares of a company you like or one you've heard that is hot. To do it well, you need a few things: learning, research, dedication, a solid plan, and honestly, a bit of passion. Without these, you're setting yourself up for a bumpy ride. When I say learning, I mean understanding how the stock market works. I mean really knowing how it works, what drives stock prices, and how to read a company's financial statements. I mean, there's got to be a bit of accounting in here somewhere, doesn't there? That's not something you pick up overnight. Research means digging into a company's performance, its competitors, and the industry it's in. You need dedication, which is about staying committed, even when the market gets volatile. And trust me, it will. Volatility is risk and risk is volatility. They're two sides of the same coin because markets go up and down all the time. Having a plan means knowing why you're investing and what your goals are and how much risk you're willing to take. And you must have passion, because if you're not passionate about reading those company reports and bringing out a little bit of your inner accountant, and if you don't enjoy the process, it's tough to stick it out in the long term. If that sounds like a lot, don't worry, it is. It really is. And that's why, for most beginners, diving straight into picking individual companies might not be the best place to start. But you don't have to do it all yourself. There are plenty of funds out there that can invest on your behalf, taking some of the pressure off while you get your feet wet. One option to consider, especially as a first step, is an index-hugging ETF. Now, what is that? An ETF is an exchange-traded fund. That's a fund traded on an exchange. I'm not playing word games here. It's just important to understand exactly what this means. It's like a basket of stocks that you can buy in one go. An index-hugging ETF specifically tracks a market index, like the S&P 500, which includes the 500 biggest companies in the United States. Think of it as a way to own a tiny piece of a whole bunch of companies without having to research one for yourself. So why might an ETF be right for you? Well, to start with, it's a low-maintenance way to invest. Instead of trying to pick winners, you're betting on the market as a whole, which tends to grow over time. And remember, we're talking long-term investing here. It's diversified, meaning your money is spread across many companies. So if one stock tanks, it doesn't wipe you out. ETFs often have low fees compared to other funds, and this is really important. Keep in mind that fees compound. The more fees you pay over a long period of time, the greater the money that's being taken from you. If you have lower fees, it means that more of your money stays invested and working for you. It's like getting a head start in the investing game without having a finance degree, which, let's face it, most of us don't. And keep in mind that ETFs can also be a learning tool. As you watch how it performs, you'll start to notice what moves the market, things like economic news, company earnings, or global events. It's a way to dip your toes into the investing world while you figure out if you've got the passion for digging into individual companies. Maybe you'll love tracking market trends and researching businesses. Or maybe you'll decide that letting a fund doing the heavy lifting is more your style. Either way, starting with something like an ETF gives you time to learn without taking on too much risk. So let's talk about risk, because this is a big one to watch out for. The stock market can feel like a roller coaster. Prices go up, prices go down. That's volatility, and sometimes it can happen really, really fast. That's why having a plan is so important. Before you invest a single dollar, ask yourself, what's my goal? Am I saving for retirement, a house, or just trying to grow my money? You've just got to actually understand why you're doing this. How long can I leave my money invested for? And really, really important, how much am I okay with losing if things go wrong? Knowing your risk tolerance will help you to decide what to invest in and keep you from panicking when the market goes south. Now, another thing to watch out for: the temptation to think that you can outsmart the market. Well, you can't. Wall Street is full of thousands and thousands of professionals, people with fancy degrees, high-powered computers, and decades of experience who are trying to beat the market every single day. They're aiming to get better returns than a benchmark, like the S&P 500 that we talked about before. And guess what? Most of them don't succeed on a consistent basis. So what makes you think you'll do better, especially when you're just walking in yourself as a beginner? I'm not saying that you can't or shouldn't try to pick individual companies eventually. Some people do develop the skills and the passion to make investment choices that are smart. But starting out, it's wise to be humble. In fact, it's really necessary to be humble. And in fact, that's one of the things I've found talking to many finance professionals, is being humble is one of the greatest assets that they can have. The market is unpredictable, and even the pros get it wrong sometimes. That's why an index-hugging ETF or similar fund can be somewhat a safer bet. It's like riding the market's overall wave instead of trying to surf every single little ripple. Another pitfall is to avoid getting caught up in hype. You'll hear about hot stocks or see people on social media bragging about their gains. Don't fall for it. Investing based on tips or trends without doing your own research is like gambling. And speaking of gambling, watch out for the urge to trade too often. Buying and selling too quickly all the time quickly racks up fees and taxes, and it can usually hurt your returns more than it helps. Patience is your friend in the stock market. Think long-term growth, not get rich quick. One last thing: fees. Every time you invest, whether it's an ETF, a mutual fund, or individual stocks, there are costs involved. Some funds charge high fees that eat into your returns over time. Remember, Wall Street's there clipping the ticket, making sure that they look after themselves, not you. When you're starting out, look for low-cost options like those ETFs that I mentioned before. Read the fine print, understand what you're paying, and make sure that they're worth it. So here's the deal. Investing in the stock market is a journey. It's a long journey, and it's okay. In fact, it's necessary to start small. Direct stock investing is tough. It takes time, effort, and a lot of learning. If you're not ready for that, an index ETF is possibly the great way to get started. Diversify your money and learn the ropes. Be realistic about your goals. Know your risk tolerance, and don't try and beat Wall Street at its own game. Well, not right away. Stay patient, avoid the hype, and keep an eye on fees. Most importantly, take it one step at a time. The stock market isn't going anywhere, and with the right approach, you can make it work for you. So remember, have a listen to these episodes that I'm producing. Have a listen to the episodes where I interview some fantastic investing experts. Keep learning, listen to the words, and just make sure that you don't lose your money. The most important thing. I'm Phil Muscatello. Thanks for watching.